Gold isn't running hot right now. Gold is repricing the credibility of the whole system, and there are powerful incentives to downplay that as just another emotional safe haven spike, because once you see what's actually driving this move, you can't unsee it. And here is the deal. By the end of this video, you want to have a clean, practical checklist for the next 1 to 2 weeks. What level matters, what would confirm the thesis, what would break it, and why a single calendar window can turn a normal pullback into a sudden gap that doesn't give you a second chance. Because the real story isn't the shiny headline that gold hit a record. The real story is what gold is replacing. And that's where the pressure starts. Right now, gold has been printing fresh all-time highs, pushing into new price territory with the kind of speed that makes people say, overbought, like it's a verdict. Then it does the thing it always does at extremes. It snaps back, it shakes hands with profit takers. It tests the nerves of anyone who chased late, and it dares you to confuse a normal retrace with the end of the move. But that dip is not the point. The point is the bid that shows up underneath it. Who is buying weakness when the headlines cool off? Because that tells you whether this is a trade or a shift. And the next detail is what flips the whole setup. If you're watching gold like it's just an inflation thermostat, you're going to miss the regime change hiding in plain sight. Inflation matters? Sure. Rates matter? The dollar matters. But the hidden detail, underappreciated, underdiscussed, and honestly uncomfortable, is that gold has started behaving like a confidence premium on policy credibility. Not a conspiracy, not a cartoon villain, an incentive structure, a market choice. When investors, institutions, and reserve managers start questioning whether the rules are stable, whether the central bank can stay independent, whether fiscal math is being papered over, whether political pressure bleeds into monetary policy, gold becomes a kind of neutral asset that doesn't require you to trust anyone buying's promise. That's not romance, that's risk management. And once that mindset spreads, price can move in a way that looks disconnected from the usual yield up, gold down rule of thumb, because the driver isn't a single variable. It's the credibility of the framework. And that's why this run has been so loud. But that's not the part that matters. The part that matters is why it's happening right now, why the calendar is doing half the work, and why the plumbing of the market can force buying even when people swear nobody is buying. Let's make this concrete. There are two versions of gold at all times. There's the gold you see on a screen, spot quotes, futures prints, the candle that everyone screenshots. And then there's the gold that shows up in the structure. The spreads, the term structure, the delivery incentives, the physical pull, the way liquidity behaves when size tries to move. Most people only ever watch the first one. But when markets shift, the second one starts talking louder. You'll see it when the futures curve stops behaving normally. You'll see it when nearby contracts get sticky, when the market starts paying up for immediacy, when the cost of rolling exposure doesn't match the calm story you're being told. You'll see it when paper claims and physical availability stop feeling perfectly interchangeable. And you don't need to be a vault inspector to understand this. You just need to understand that gold exposure can be created with a click, but gold delivery is constrained by formats, logistics, refiners, and approved warehouses. It's a supply chain that looks liquid until it doesn't. And when uncertainty rises, people stop asking for exposure and start asking for certainty. That's when the paper market starts to feel the gravity of the physical market. And that's where the real pressure starts. Now, before we get into the catalysts, we have to answer the skeptic's first question. Why gold? Why not just buy cash, buy short-term treasuries, buy the dollar and chill? In a normal regime, that's the playbook. The reserve asset offers yield, liquidity, and trust. But if the market starts pricing policy uncertainty instead of policy direction, the calculus shifts. Cash is great if you trust the system you're holding it in. Treasuries are great if you trust that the path of rates is guided by a consistent framework and that the fiscal path doesn't force ugly choices. The dollar is great if you believe its dominance won, and to be challenged by reserve diversification and geopolitical fragmentation. Again, not a doomsday prophecy, a portfolio problem. Gold becomes a way to step outside the argument. No counterparty risk, no default risk, no someone else's liability. And when that preference rises at the margin, when even a small percentage of big pools decide they want more neutrality, you don't need everyone to buy gold. You just need the marginal buyer to be price insensitive, and that's how you get record runs that feel like they came out of nowhere. But there's another engine in this move that people miss because it's not cinematic. Dealers and hedging, options, reflexivity, the market turning into a machine. Here's the clean explainer without the math headache. Options exist at certain strike prices, and when the underlying price approaches those zones, the people who sold the options, dealers, market makers, often hedge their exposure by buying or selling the underlying. That hedging isn't opinion, it's defense. And depending on where price is relative to big strike concentrations, hedging flows can amplify moves. In some conditions, as price rises, dealers have to buy more to stay hedged. That's forced buying. Not because they're bullish, but because they're short gamma and the hedge ratio changes against them. In other conditions, the hedging dampens movement. The key is the regime and the positioning. You don't need the exact strike map to respect the phenomenon. You just need to know that around key expiries, price behavior can get weird. Fast ramps, air pockets, sudden reversals, and why did it move on? No news. Moments. And late January is one of those windows where the calendar compresses risk into a narrow hallway. And that's the next detail that flips the whole setup. Look at what stacks up in this specific period. You've got major month-end positioning dynamics where funds care about month-end marks and risk budgets. You've got options expiry dynamics that can concentrate hedging flows. And you've got a major policy moment right in the same week. A central bank decision that can change the narrative on rates, credibility, and risk appetite. When those hit together, liquidity thins at exactly the wrong time. That matters because gold is not just a view. It's a hedge that people adjust quickly when their macro narrative changes. A month-end close can force rebalancing. An options expiry can force hedging. A policy meeting can force repricing. Put those together, and you don't get a smooth trend. You get a series of squeezes and shakeouts. And if one level breaks, the math changes. So let's talk about levels, not as fake precision, but as a practical map. When an asset makes new all-time highs, there isn't historical resistance in the classic sense. So the market creates resistance by behavior, round numbers, recent highs, breakout shelves, and the zones where dip buyers prove themselves. The first thing you watch is whether gold can hold above the breakout shelf on a pullback. Call it the most recent consolidation zone beneath the highs. If price revisits that area and buyers show up aggressively, especially on down days, especially when the news flow turns bearish, that's confirmation that the bid is structural. The second thing you watch is whether weekly closes hold the new regime. Intraday spikes can lie. Weekly closes tell you whether institutions are willing to hold exposure through the weekend, and weekends are where geopolitical risk and currency stress like to show their teeth. That's not drama, that's history, but that's not the part that matters. The part that matters is the proof stack. Because if you're going to trust a thesis with real money, you don't want one argument. You want 5, you want 6, you want redundancy. So here's the stack. Mechanism, behavior, structure, and symptoms, without pretending we have perfect measurement of everything. First proof point, the price behavior itself. Record highs followed by dips that get bought is a signature of a market transitioning from trade to camera allocation. Trades die when dips are sold. Allocations survive when dips attract fresh size. Second proof point, the macro narrative isn't just inflation. It's uncertainty around policy credibility and the independence of the rate-setting process. That kind of uncertainty increases the value of neutral reserves. Third proof point, institutional channels are open. ETFs and ETPs can become flow accelerators. When inflows appear, share creation requires hedging and sourcing exposure, and that can tighten the loop between price and demand. Fourth proof point, central bank and sovereign demand has been structurally elevated in recent years. Again, you don't need to know the exact tonnage this week to respect the trend. Reserve managers have been diversifying, and that demand tends to be less price sensitive than fast money. When that's part of the baseline, dips behave differently. Fifth proof point, global arbitrage and physical pull. When certain regions pay a persistent premium, it signals local demand or local constraints, and arbitrage draws metal and exposure across the system. That can tighten availability in specific forms, even if the world has plenty of gold in the abstract. Sixth proof point, market structure signals, term structure behavior, and spread sensitivity around delivery windows. When immediacy matters, the curve tells you. When it doesn't, the curve relaxes. You watch whether the market starts paying for now instead of later. And when those 6 layers point the same direction, you don't need a conspiracy. You just need the system behaving exactly as incentives predict. And that's where the real pressure starts. Now let's do the thing the internet hates. Acknowledge counterpoints like an adult. Because this is finance, not fan fiction. Gold can absolutely slam lower even if the big thesis is right. You can get a dollar surge. You can get a hawkish surprise. You can get a risk-on melt that pulls money out of defensives. You can get a sudden peace headline that crushes the geopolitical premium. You can get an unwind where leveraged longs get forced out and the chart looks like it broke, even though the underlying allocation demand is still there. And the worst mistake people make is thinking thesis correct means price action smooth. Price is allowed to be violent. In fact, price tends to be violent precisely when the thesis is correct, because the market uses volatility to shake weak hands before it moves into the next regime. And if you don't plan for that, you'll get emotionally mugged. So let's put a simple, credibility-preserving 2-scenario lens on this. Scenario 1 is the controlled pullback and retest. Gold cools off from the highs, drifts back toward the breakout shelf, maybe even undercuts it briefly to trigger stops, then recovers fast. In that scenario, confirmation looks like buyers stepping in on weakness, a quick reclaim of key levels, and a refusal to stay below the shelf for more than a couple sessions. It feels annoying. It feels like the market is wasting your time. That's the point. Scenario 2 is the continuation, squeeze, and gap risk. Gold doesn't give you the polite pullback. It consolidates shallow liquidity, thins into the calendar window. And a catalyst, policy language, data surprise, geopolitical flare, or simple option hedging reflex, forces dealers and underallocated funds to chase. In that scenario, the market can jump levels overnight. It can skip your limit orders. And that's the scenario where people later say, I was right, I just didn't get in. Both scenarios are plausible. The way you stay sane is by deciding in advance what would confirm and what would invalidate. Invalidation doesn't mean it dipped. Invalidation means the market breaks the breakout shelf, fails to reclaim it, and starts making lower highs while liquidity on rallies dries up. Invalidation means the bid disappears on down days. Invalidation means the structure changes, and that difference between noise and a regime shift is where professionals live. But that's not the part that matters. The part that matters is what participants are forced to do. Because market moves are not just opinions, they're constraints. Think about who's on the other side of this. Dealers who sold upside calls, funds that are underweight gold because it's been boring for years, and now it's not. Institutions that benchmark against inflation hedges but hate buying at highs. Corporates and industrial users that might not be huge in gold compared to other commodities, but still interact with the market through hedging, jewelry demand cycles, and inventory decisions. And central banks that don T want to be caught with a reserve mix that looks politically exposed. When the price makes new highs, it doesn't just attract bulls. It pressures the neutral and the skeptical to reassess. Underallocation becomes risk. That's reflexivity. That's how a chart becomes a narrative, becomes a position, becomes a flow. And when that loop gets going, the market stops caring whether your favorite commentator thinks gold is too expensive. The market cares who is short, who is underweight, and who needs to rebalance by Friday. And that's where the real pressure starts. Now, let us talk about the paper versus physical tension in a way that's useful and not melodramatic. Futures are amazing. They provide liquidity and price discovery. They let hedgers hedge and speculators speculate. But futures are not the same thing as a bar in a vault. Futures have delivery rules, warehouse categories, and a chain of conversion that matters when stress rises. Warehouses can hold metal that is deliverable against a contract and metal that is registered for delivery. Different buckets, different immediacy. In calm markets, nobody cares. In stressed markets, everybody suddenly cares. Because when more people want the certainty of deliverability, the premium for the right kind of metal in the right place, in the right format, can rise. That doesn't always show up as a screaming headline number. It often shows up as persistent tightness, odd behavior in nearby spreads, sudden bursts of backwardation-like behavior, and a general feeling that size moves price more than it should. That's not proof of a shortage of gold in the universe. It's proof of constraints in the delivery pipeline. And constraints are exactly what markets reprice. Now layer in global arbitrage. Gold is global, but it's not perfectly frictionless. Different regions have different demand patterns, import rules, and local liquidity. When one region is willing to pay more, because demand is hot, currency is stressed, or local buyers are panicking, that premium can attract supply and drain it from elsewhere. Arbitrage closes gaps, but not instantly. There are logistics, paperwork, refining, and timing. The spread is the signal, and spreads are the truth tellers because they represent what people will pay for time and certainty. Everyone's watching the headline, but the signal is somewhere else. And if you start watching those signals, you stop getting whiplashed by every intraday candle. Which brings us to the real why now. Late January is a calendar trap, not because there's a magical date that always does the same thing, but because risk gets concentrated. Funds care about monthly performance marks. Some strategies mechanically rebalance near month end. Options, expiry compresses, hedging flows. And policy events reprice narratives. If gold is near record highs going into that window, the incentive for dealers to hedge and for underweight funds to chase increases. Meanwhile, liquidity can thin because people de-risk, books get tighter, and nobody wants to be the hero providing size into uncertainty. Thin liquidity is gasoline. It doesn't create the spark, but it turns a spark into a flash. And that is why you can see moves that feel discontinuous, like the market teleported, when in reality the order book just couldn't absorb the flow. And that's where the real pressure starts. So what should you actually do with this information as a finance-minded retail investor who refuses to be emotionally farmed? First, separate trend signal from noise. Trend signal is the market holding its breakout shelf, maintaining strong weekly closes, and seeing dip buying that persists even when the news turns negative. Noise is intraday volatility, social media panic, and one-off candles around data releases. Second, respect volatility as a feature, not a bug. Even if the thesis is right, price can whip around violently. It can drop hard to clear leverage. It can spike to punish shorts. It can chop to exhaust you. If you can't emotionally survive that, your sizing is wrong, not your thesis. Third, adopt the two-scenario lens and pre-commit your reactions. If we get scenario 1, a controlled pullback and retest, your job is to watch for structure, not predict the exact bottom. Does the market reclaim key levels quickly after undercuts? Does selling pressure fade on subsequent dips? Do rallies happen on broad participation or just thin squeezes? If we get scenario 2, a continuation squeeze, your job is to avoid FOMO decisions that ignore gap risk. Chasing can work in squeezes, but it can also trap you at the worst possible point if the move was hedging driven and then snaps back when hedges unwind. You want a plan that survives both worlds. But that's not the part that matters. And the part that matters is what to watch next week and the week after in a way that gives you genuine edge. Here's the checklist. Watch the behavior on down days. In a real regime shift, down days don't feel free. They feel bought. The market refuses to give you comfort. Watch the weekly close relative to the breakout shelf. If gold holds above that shelf into the weekend, that's a statement. Institutions are willing to carry the position through headline risk. Watch the dollar and real yields, but don't worship them. In this environment, gold can move because the market is pricing credibility risk, not just inflation math. Watch for policy communication that either stabilizes the credibility narrative or inflames it. Watch the curve and the spreads. You're looking for any sign that immediacy is being priced. Tightness, sensitivity, weirdness around delivery windows. Watch ETF flow direction and holdings changes as the sentiment channel, not as gospel. When flows shift, they can reinforce price, but they can also reverse sharply and create air pockets. Watch global context. Premiums, local demand narratives, currency stress in regions where gold is a cultural store of value. When global buyers are active, dips don't last as long. And one more thing, watch how the media talks about gold. This sounds fluffy, but it's behavioral finance. Early in a real regime shift, gold is mocked or ignored. Then it's explained away, then it's treated as a problem. When it becomes a problem, institutions that ignored it start hedging, and that's where the real pressure starts. Now, let's talk about the psychological traps that will try to pick your pocket. The first trap is the I missed it narrative. Gold hits a record. You feel late, you hesitate, then it dips and you feel smart, then it rallies and you feel stupid, then you chase, then it dips again, and suddenly you're trading your emotions instead of your plan. The market loves that cycle because it converts your attention into fees and slippage. The second trap is the one candle trap. A sharp red day will convince you the thesis is dead. A sharp green day will convince you need to buy immediately. Both are usually wrong. The third trap is the authority trap. Someone with a title will tell you it's just this one factor: rates, inflation, geopolitics, and if that factor reverses, gold will crash. Real markets are multi-causal. When you're watching a shift, you need a stack of reasons, not a single cause you can get whipsawed by. The fourth trap is leverage. Gold is a market that can humble leverage fast. Even if you're right, a 3% move against you can be a margin call if you resized like a hero. And margin calls don't care about your thesis. They care about your balance. The antidote is boring and powerful. Size so you can survive. Define your invalidation and let the market prove you right rather than demanding it on your schedule. But that's not the part that matters. The part that matters is the bigger economic shift gold is signaling. Because gold doesn't usually lead when everything is stable. Gold leads when the system is asking new questions. And the question right now is not, will inflation be 2% or 3%? The question is, what does the world trust as a reserve and as collateral when politics, policy, and geopolitics start tugging on the old framework? In a world where supply chains fragment, where sanctions and trade realignments reshape flows, where fiscal math gets louder, and where central banks are scrutinized as political actors, the demand for neutral assets rises. Gold is not the only beneficiary. Sometimes it's energy, sometimes it's industrial metals, sometimes it's currency alternatives. But gold is the cleanest barometer because it sits at the intersection of money, fear, and reserves. When gold is making records, it's a market saying, I want optionality outside your promises. That's a warning. Not because the world ends, because the world adapts. And adaptation reprices assets. So what comes next? Here's the near-term roadmap in plain language. If we stay above the breakout shelf and the dips keep getting bought, the path of least resistance remains up, but it will not be straight. Expect violent pullbacks that look like reversals. Expect fake breakdowns near key calendar moments. Expect squeezes that happen when you least expect them, especially when liquidity thins and hedging flows kick in. If we lose the breakout shelf and fail to reclaim it within a few sessions, that's your first real warning that the move may be transitioning into a deeper consolidation. That doesn't automatically kill the bigger shift, but it changes the timing, and timing is risk. If the market gaps higher through a key zone without giving pullbacks, treat that as a squeeze condition. Manage risk like a squeeze, not like a gentle trend. And in both scenarios, don't ignore the possibility that the market weaponizes volatility against you. It will try to make you sell the bottom of a dip and buy the top of a rip. Your job is to refuse to be predictable. Decide ahead of time what you do in each scenario. That's how you keep your edge. And here, it's the subtle truth that separates tourists from operators. You don't need to be perfectly right about direction to win. You need to be right about structure. If the structure says the bid is structural and the regime is shifting, you position so you can survive the noise. If the structure says the bid has vanished and the move is unwinding, you step back without shame. The market doesn't award loyalty points. It awards discipline. Now, before we close, I want to give you one final metric that everyone should watch, because it will tell you whether gold is acting like a simple trade or like a system signal. Watch what happens on bad news days. When headlines are supposedly bearish for gold, strong data, hawkish talk, a dollar pop, does gold collapse and stay down, or does it dip and recover? Recovery on bad news is a hallmark of regime shifts. It means the market S buyer is in T reacting to the same inputs the crowd is reacting to. It means the buyer has a different objective. And when that happens repeatedly, it's the market whispering that the bigger economic shift is already underway. If you're still here, you're not here for vibes. You're here for mechanisms, structure, and what to watch next. So stay in that lane. Build your plan, watch the checklist, and don't let volatility bully you into dumb decisions.